I'm delighted to welcome a very eminent panel, I would say, and I'm not going to read all their bios because we'd be here for an hour if we had to discuss all the accolades and achievements they have. But I think it's a very apposite point to follow on from the Vice President. I think 10 years on from the financial crisis, the focus is now shifting to how the financial sector can foster sustainable economic growth and deliver on the Paris Climate Accord commitments. And we also heard that in order to achieve that, the EU alone needs 180 billion euros per annum to invest in a low-carbon economy and to mobilize, therefore, private and finance and capital towards that aim to scale up the investments for growth. So I certainly believe, from my experience on the high-level expert group, that there is a growing mood within the financial community and all of the stakeholders now to establish the building blocks of a new financial architecture, which will help to deliver on those twin goals of the SDGs and, of course, the Paris Agreement. Just a couple of facts that I think that are interesting. 2017 was a record year for green investment products. Green bond issuance doubled. Since the launch of 2015, the SDGs, they've attracted significant corporate investor and government attention. Investors of all types now are paying more attention to sustainability. Financial institutions are responding by setting up their own units dedicated to sustainable investing. And we've seen the emergence of new disclosure guidelines with the TCFD on climate disclosure, which are actually demonstrating that there is more demand out there for info on transparency around sustainability risks and performance of companies. So I think we're on a new track now, and that's why I'm very delighted that we have this knowledgeable panel with us, and I hope we can jump straight in now to the debate and try to get some answers to some of the questions I think that people are thinking about out there. I wanted to turn to you, Masamichi Kono, as the Deputy Director of the OECD, first of all. We heard the Vice President say that finance is global. That means you have to have global action. So what is the OECD doing to deliver here or to push the agenda around sustainable finance?
Thank you very much. It's a great honor and pleasure to be here. And the OECD's motto is better policies for better lives. And we have 35 member countries, but we now are active beyond those member countries and in basically all policy areas. And so, of course, increasingly this area of climate-friendly or sustainable finance is a focus of some of our work. But if you take, of course, sustainability, this is actually relevant for not just finance or environmental policy, but far beyond, involving labor market issues, education, health, and we at the OECD are promoting what we call a whole of government approach to those issues, and we would like to use our convening powers, leverage our work that we've been doing in all those areas to achieve this objective of SDGs and also the Paris Agreement. Now, if I may, last year in the G20, at the request of the German presidency of the G20, we issued a report entitled Investing in Growth, Investing in Climate, Investing in Growth. And in this report, we argue that if we take the right policies, this is a very important condition, that is climate-compatible policy package. If we apply that, actually we can make those additional investments required and also the negative effects coming from the required transition consistent with growth. And we can have growth and also a certain path that will bring us towards the Paris Agreement objectives. But again, this condition is very important that we have to apply the right policies and the additional investment, although this incremental is not that large. I mean, we just heard from Mr. Dombrovskis this amount required in Europe, but globally, we calculate that 6.3 trillion US dollars of investment per year is already required between 2016 and 2030 in any case. And then if you want to make this climate friendly or climate compatible, you add another 0.6 trillion. And of course, with the application of other very important policies for inclusiveness, we will be able to come close to those goals that we set ourselves for in the Paris Agreement.
Good. Yeah, so that's a lot of money, though. $6.3 trillion is a lot of money.
Yes.
So maybe I can turn to you, Axel, as one of the visionaries, I think, in the global banking system who understands many of these issues. How do you think that private capital can be mobilized to do this job? Is it possible? Is there an appetite for it?
I think it's absolutely right, as Maza said, that this G7 and G20 framework, while pointing out the issues, will not, the public sector in no case will be able to close these financing gaps. Oh, sorry. I was the only one that didn't ask for being mic'd up. Sorry. The private sector has to come to the help. The public sector, G7, G20, cannot close the financing gap. The numbers we have are very similar to what Masa said, 5 to 7 trillion globally, annually, over the next couple of years until 2030 to close the financing gap. There is a number of private sector players that the public sector is engaging with, for example, asset managers, pension funds, insurance companies, institutional investors are coming to this market. But before institutional investors can invest in this, you need to move these types of investments from being niche to being mainstream. And that requires a lot of infrastructure to be done. I remember a couple of years ago, I was in Bonn. I used to sort of have my main residence in Bonn. I went to see the United Nations. I was talking to Cristalina Figueres, and as one of the results of our engagement in Davos over many years, we have committed that we can raise at UBS alone in our client base 5 billion for sustainable investment, over 1 billion over every of the next years, and we announced that last year. Why is that the case? It's not just institutional investors, it's also private investors that want to engage on sustainability. And there is no conflict between financial returns and impact investing, for example. And so, in particular, when you look at private wealth, if you look at, for example, the family offices of the richest individuals on the planet, they are doing a lot of impact investing and philanthropy anyway. But they're also very open to move more to sustainable investing. Many of the millennials that will be the major inheritance of wealth want to combine investing and doing goods for society with investing and doing good financially. So I think there is not just a need for these investments, there's also a demand for investing. And what we need to do as financial institutions, bring our financial engineering capabilities to these products. Let me give you two examples. The first thing we started to do is define what is actually sustainable. And then based on that, you need to have a very clear definition, because there's a lot of things that sail under the flag of sustainable, but they're sustainable to various degrees. So you need to be very clear, what is it that constitutes sustainability? Second is, as you do that, you need to have third parties attest whether you are sustainable or not. So, the major audit firms need to come to this and attest sustainability. Once you have that, you can develop an index, and UBS has been at the forefront of developing such indices of sustainable investment. We're the first company that has developed 100% sustainable investment product offering. And once you've done that, you will get institutional investors that can start writing ETFs and structured products based on an index, and as you deepen the market and become more liquid, you will get derivative markets to develop, and that will be the the core of when institutional players need to come in. So whilst we need to understand that there is the need for it, we also need to bring what banks are good at, and that is providing financial infrastructure and expertise to developing markets. And I think that's something that we really need to push in the next few years. I think the private sector is the best friend of the public sector here in developing sustainable investments.
Great. So that, I think, neatly brings you in, Martina, in a sense that, you know, we have the institutional structures, the private sector is willing to step up and to mobilize. And I think Axel talked about the issue about indices, and we do need structures in the market to be able to deliver. So in your view, do you think that those structures are there? We know the Vice President talked about we need a taxonomy, we need standards, we need to look at labels perhaps. Is that a developing market that you think is going in the right direction?
Very much so. I think it's quite interesting of comparing panel 1 this morning with panel 2, because the challenges are very similar, even though the topics are of course different. So looking at standards and taxonomies and the harmonization of these standards is the one key aspect. The consistency of metrics and data is the other big topic. Maybe cross-regulatory collaboration could enhance this discussion, and ultimately moving from codes, voluntary codes, to mandatory regulation/legislation is probably another movement that we have seen quite significantly in this space. Interestingly, the points of assurance, I think this is an additional element. You know, we have seen that in the green finance, green bond space, increasingly assurance is important to get further guarantees, verifications on actually the greenness of products and how they're delivering towards their actually expectations, and potentially also expectations set out towards impact. It's another big topic that's coming arising increasingly also in the context, of course, of the great work UBS is doing in this field. And Axel, apologies, Weber mentioned, you know, the commitment from large-scale banks and investment managers and insurance companies. We've heard this from Elizabeth Corley this morning, towards, you know, green finance, the Paris Agreement, risk mitigation, adaptation and resilience building and impact, as well as ultimately the commitment now of the financial services community towards the Sustainable Development Goals. So definitely there is an alignment of goals between what's happening in public policy, in the corporate sector, and ultimately amongst investors. And there's another drive here. I just wanted to mention the sustainable investment market has grown significantly. It's somewhere around $23 trillion now. It's a third of the world's markets, actually, assets under management, committed towards sustainable investment strategies. And hence, you know, I think there is generally now quite a market move towards sustainable finance and investing. But one key element, and Axel Weber also mentioned this, is actually the relevant products and the infrastructure to build these products. And in my role at S&P, I used to be the head of ESG indices. I've constructed products that literally look at green finance implications, integrating green finance frameworks into actually investable instruments, and looking at how can you combine various practices, may they be fundamental, may they be thematic, may they be factor related, and actually build cross-border hybrid solutions that could enhance and mainstream the ESG debate.
So it's a complex area as well, though. I think it's not
complex area.
No simple solutions.
Many of the challenges from this morning running right into this panel, absolutely.
Guido, can I turn to you now, because you as Swiss Re really has put all their eggs in the sustainability basket, haven't they, in many ways? You've gone for moving 130 billion of US dollars investment portfolio into ESG benchmarks. And I just wondered what you think is the future here, why you've done that. But I presume because it's investor demand. But do you feel that you have enough of these kind of standards and labels? Are there enough products that you can point people to? Can investors make the right choices about where to put their money because they've got the information?
As you pointed out rightly, we did a huge step last year. Swiss Re, of course, we are exposed to environmental risk anyway. That's part of the business model, being basically one of the biggest global reinsurance company. That's why environment really matters across the company. Very clear on the insurance side, reinsurance side, but also we made it ultimately as the main topic also how we manage our own assets. We have a bit of policyholder funds, which is a separate pot, but Swiss Re's own asset basically is fully compatible with ESG. Why we have done it? Not only for providing input for a more resilient world, it also makes economic sense. And you mentioned it before, this move is now much more clear than 5 years ago. And Swiss Re has invested a lot of time to understand what it means if you move an institutional portfolio into the ESG space. And that's why very proud to say it's not only for helping a more resilient world, it also makes economic sense. Now, particular for long-term investor, as many of us are, that's why this is a natural home turf, and we did all the homework which you would expect to stress test backwards, but also forward-looking what the dynamic is in the portfolio. And we started 18 months ago. We did the public announcement mid of last year, and the achievement and findings so far are really encouraging. That's why I think happy to invite others to follow. I think we are still the only insurance companies globally which have moved in that space. Now, it's clear, for us it's a topic. It's also a topic for the generation which we referred to before, millenniums. It's very clear they will behave differently. By 2020, 24 trillion are managed by millenniums, and they have different criteria than many maybe of more traditional investors have. That's why it's a win-win, both for society, it makes economic sense, and it's clearly also very important for all generations. Now, it's a long-term journey, and we are learning by doing. We made the decision we want to be an early mover, and ultimately what we did is part of a longer strategy. Our company have been responsible investors more than a decade. We were one of the first signatories on the PRI, and as usually you start with exclusion. That's the easy piece, to exclude certain companies, and in that context we always had exclusion. 1.5 years ago we sold all terminal coal-related companies which have a concentration risk in their bottom line contribution. That's exclusion, that's fine. And then we have a lot of thematic investment like green bonds or renewables, but this is still a fragmentation of the overall potential of long-term investor like pension funds and insurance company. That's why even if green bond does grow, but maybe it's 1% or 2% of the overall allocation. The most meaningful piece is benchmark, and because you tell the people who make a decision every day, now a new basically bar has raised. You have to look at ESG on a company level, and of course you can decide to invest 2 billion in green bonds. Then you have to find the supply, which is not easy, but much more powerful is that you give the people who decide every day, every hour, which stock or which credit issue is more attractive. And that's about incentive. And for me, the most powerful story is you basically give incentive to companies to put more emphasis on ESG because they have a different funding rate. And of course, that's very natural. Although if you give someone the incentive, then he starts care about ESG. The worst case is if you just exclude full sector or a specific company. That's the last measure. But the much more meaningful way is you give time to a specific company, a specific sector to improve. And that's social. That's why there's ESG as an environment, but there's also a social component. That's why the incentive piece is the much more powerful, and I think also the more sustainable piece. And for me, the right answer is in financial market, in particular, if you're responsible for institutional portfolio, is the benchmark discussion. Now, again, we looked at many benchmarks, and we derived at some conclusion. But this is work in progress, and many things which Axel has mentioned, but also you, it's very clear this is anything else than a final architecture nor framework. But we make a decision helping to phrase it, also share basically our experience so that we can attract even more attention.
Can I just ask you what you mean by incentives, though? I mean, what do you mean by incentives? What kind of incentives will you give to companies to move in this direction?
So you have the classical kind of ratings, as we all know from the rating agency, and this is an idiosyncratic type of assessment. Now, ESG, quite often, you also get ratings, but it's relative to the sector. That means how well you are doing on ESG compared to your peers in the same sector. It's a different rating philosophy. And of course, if you have a higher rating, probably you get more attraction from some investor, and the more basically who join. It's a self-fulfilling story, and that's why you will most likely have a different funding rate, medium to long term, a more attractive one if you have a higher ESG score, just more demand. And that's why you help company to put some pricing to the ESG footprint. Right now, many things are soft, how you want to basically define environment, social, and governance. But if the market starts to deviate between companies because of the different ESG rating, you start to give a cost or pricing label to that piece. That's incentive. Yeah.
Good. So I just really want to go back to this point, because the Vice President was very clear about the fact that one of the first items they will tackle in the action plan is to look at the whole taxonomy, how you look at indices, benchmarks, standards. Maybe I can just ask you quickly, Masamichi, what are you doing in the OECD on that and standards? Because is there not a concern that if the EU races ahead with its own standards, you have a European standard, and as we said, markets are global, and we don't really need to have a specific EU standard unless it's linked or part of a global standard. What are you doing on the standards front?
Yes, thank you very much. And I think we welcome European leadership here. And of course, when we want globally consistent approaches to this overarching issue, eventually we will need more dialogue, more cooperation across jurisdictions. But on the other hand, someone has to take the lead. And certainly this high-level expert group report is a very comprehensive, very ambitious project. And there are many elements in it which will need to deeper consideration. But let me come back to policies, and I very much also heartened that the private sector is now really taking an interest and taking initiatives to incorporate those goals in their strategies. But policies will have to be the best friends of the private sector and the markets for this to work. And when we talk about the incentives, I mean, certainly there are many problems with, for example, fossil fuel subsidies in many jurisdictions, not necessarily in the advanced economies, but more in the emerging market world. There's also an issue of carbon taxes. Not enough use is made of them. There are many misaligned incentives when, of course, you want to develop renewable energy sources in, again, in emerging market countries. And transparency and disclosure, all important, along with the taxonomy issue. And again, the task force at the FSB, and of course you have a lot of credit in that, but made a lot of progress, but there's more room to actually have this implemented, and also further elaboration of the different circumstances in different jurisdictions. Mm-hmm.
Axel, UBS is very good at producing a report. You produce an annual report on sustainability, and you use the GRI standard, I think. So, you know, your disclosure reporting fundamental to the DNA of your company. And in fact, you are one of the leaders, I think, in the industry group of the Dow Jones Sustainability Index. Congratulations for that. So where do you think we need to go in this space? Because, and I'm going to come back to Martina afterwards, but I know that TCFD came out with a view that one of the problems is that you have got something like 400 standards out there. Everybody's reporting in a different way. So this core idea of having a standard and global standard seems to be very fundamental to actually getting results.
Yeah, so I do think you need to start streamlining some of these developments, because everyone starts off on, you know, a very admirable course, but in the end, markets are global and standards need to be global. You mentioned the Dow Jones Sustainability Index, which we've led for 3 years in a run. And I think it was because we started concentrating on what we want to achieve. Give you an example, there is increasing need in our investor base. It's just, you've seen it again this year. When the CEO of BlackRock, one of the largest asset managers, in his annual letter addresses sustainability as one criterion for where these funds will invest. It will not just be passive investment along the index. It will be guided by a sustainability index, which might be quite different from the S&P 500 in itself. So the sustainability part basically overweights companies that have sustainable benchmarks and deliverables, and it underweights those that don't. And that's the first thing. I think there is an investor drive and need for that, because those large investment companies see it in their client base that the client is asking, what do I invest in? Does this help further the course of, say, the carbon objectives? And so there is a clear demand, and I think it will increase. The second one, and Martina mentioned that, is we very much endorse the Disclosure Task Force voluntary standards. Of course, like with every voluntary standard, the adoption of it is not entirely voluntary, because there is the threat point. And the threat point is, if we do not, as a private sector, move along there, things like environmental stress testing and basically also capital requirements related to non-environmental friendly activities, including risk weights increasing on trapped assets that are related to a non-carbon world, is clearly the point where I think, as an ultimate threat point, it is out there. I don't think it will be enforced anytime soon, but it is very important for the private sector to understand that this is not just a global policy agenda, it is also something that is needed in order not to face big tail risks further down the road. And as Guido mentioned, for an insurer, it's very clear they're hit on the passive side of their balance sheet by a lot of environmental risk. So the natural course for them is actually to start insulating some of their balance sheet on the active side of the balance sheet with more sustainable investment. And so I think there is a big institutional investor space out there that will ask for it, but it's not just that. I think benchmarking will bring this to retail investors. Just as we discussed before, the wholesale market and the retail market here, there may not be such a big need at this point in time to bring sustainable investments to retail, but that's really where a lot of the deep money and the deep pockets sit. And that's why I think it's important to go a dual track, develop the institutional framework, and that's where the indices, that's where the disclosure, that's where the auditing, all of this plays a role. But look at private investors. Most of our wealthy individuals with family offices out there, I'm paraphrasing, spent their life earning money and then spent their retirement spending it on philanthropy. That's not something that you need to sequence this way. There is a very good way to combine impact and impact investing with financial returns. The bigger the impact is, say, if you tie it to carbon objectives, the more financial returns you get if you foster these developments. So I think, again, to financial engineering, financial institutions, having been at the core of the last crisis and everyone seeing sort of, the downside of finance industry, is really under a big obligation to deliver what it can deliver in terms of helping improve the upside, in particular in this area. And I think given the financial expertise and engineering that is in all of our institutions, we can work with the public sector to make better markets, deeper markets, more liquid markets, and more global markets around sustainable investing, impact investing, green bonds. And financial returns and profitability is not an alternative it doesn't stand in the way of that. It actually is a complement. It's not a substitute. And that's, as we bring that to our investors and to our clients, they understand that sustainability is a complement to an investment process rather than foregoing returns in order to foster a better course.
Martina, you talked about alignment, the need though for alignment, because there are a lot of standards out there. How do investors make sense of this then? If I'm looking to invest and to put some money somewhere, how would I make sense of that? If I look at a company's profile, I see that they've got a good sustainability index, but how would I make sense of that? I mean, is there something different we need to do here? And I would like you to look at this interplay between voluntary and mandatory. Do we need to have mandatory standards? Should the EU press ahead with mandatory standards? even if the rest of the world doesn't do that?
Very good questions. I think, first of all, we probably have to differentiate, when we said earlier, from voluntary codes to mandatory legislation. You know, there are a variety of different types of frameworks out here. So we have legislative frameworks these days, like Article 173, Energy Transition Law in France is a prime example. EU Directive 2014-95, which is coming into force in multiple EU member countries as of this year for reporting as of next year, which looks for disclosure of non-financial information. Diversity is another key example. These are actually now mandatory legislative requirements that actually will hopefully enhance over time the conundrum of what we have seen around consistency of data and metrics, and ultimately reporting at the corporate end. So that means metrics and integration of ESG factors within investment decision making versus currently more qualitative reporting that then features obviously also in certain benchmarks, such as DGSI, which was mentioned. It's been always seen as a conundrum in itself. Then the second type of standards and frameworks are obviously the normative frameworks. They have been by remit much more global. So we are talking about the UN Global Compact, Sustainable Development Goals, probably a variety of other different standards here aligned with this as well, and standards in their own right, the ISO standards, for instance, that actually looked for more harmonization of specific topics and issues. You have them for environmental, you now have them up and coming even for green bonds. The ISO is working on a green bond standard, and a variety of different other topic areas. And then you have got the reporting standards, and these are the GRI, we've mentioned this, IRRC, SASB increasingly, which is obviously more of an integrated accounting standard. So I think to make sense of all these different type of frameworks in its own right, probably we have to take maybe the discussion towards a meta framework, something I'm working on at the moment to understand what are the common denominators, the factors and metrics that run throughout these type of decision-making tools, vehicles, potential decision-making tools. And then ultimately there is another area closely aligned when we come to investment decision-making, which are of course the benchmarks. And we mentioned this here, the role, the importance that benchmarks are playing, and understanding the shift from what we classify as niche to core. Swiss Re has undertaken that journey. AMF, a large Nordic asset owner, has undertaken the same sort of journey. I think is literally moving the allocation towards sustainability benchmarks that don't have per se maybe a size or sector bias, that could actually provide further insights into specific ESG related themes. But then again, the question remains, how can you compare the debate, right? And literally the mainstream versus the sustainability related factors. I think for me, the last but not least point I wanted to make here is maybe more hybrid solutions. I've mentioned that in the context of products as well, that you look at specific factors, size, momentum, volatility, and then how they actually harmonize or differ, correlate, non-correlate with ESG specific information. There is one route actually of creating products that could harmonize the information. Again, if we come back to reporting or any type of legislative or normative standards and frameworks, the debate will probably continue. But again, we will probably need to take it at one point towards a meta-type framework discussion, as I mentioned, or hear what the HLEC EU Commission has tried. And again, it might just be for the EU jurisdictions. Again, there's a conundrum towards the global perspective to look at building really more harmonized taxonomies, and that will literally then feature into
But the factors of that would be to have a core set of standards that are consistent, comparable materials, so that that would help the investor. So the question then, I think to you, Guido, is do you think that there is enough quality out there in data that's available to investors? Is there enough granularity so they can make those choices and decisions?
There's never enough data. It's very clear, particularly nowadays. But you have to start somewhere, and that's why we spend considerable amount of time, resources to really understand what it means if you move more into ESG or completely into ESG. And that's why I'm so convinced, because I saw the analysis, I saw all the stress tests, I saw all the scrutiny which have been applied in our internal approval process. That's why I can really say it makes sense economically, also from a shareholder's point of view. And it's particularly true for fixed income. If you look at corporate bonds, a bit less true, but still true on equity. Now, this is the current kind of findings, but there's no excuse not doing it. If you believe in in a risk-adjusted view of the world, there shouldn't be any debate, in my view, not making such a move. The biggest point probably is the G, governance. That's an obvious one to financial market. Of course, if a company has screwed up or challenges on the governance, then you see the big kind of cliffs in investor reaction. The environment is a long-term piece, and of course the social even more long-term. Yeah. That's why you need a lot of data to understand not only a 5-year time series, but a longer one. And it's true, ESG is a topic probably more in the last 5 to 10 years than in the last 20 years. And many of us probably never have attended a course on ESG. If you look at our financial market analysts, they didn't have any educational training how to incorporate ESG into their whatever cash flow modeling, embedded value calculation, etc. That's why it's really started education. Mm-hmm. Of course, we started moving on the institutional books because we believe it has the momentum, it has the economic view, but we should also spend time in learning and basically using the learning in the education. And that's why the interesting discussion I have with financial analysts, how do they model ESG in their normal kind of corporate assessment and evaluation. Now, documentation helps, no doubt, but again, it shouldn't be an excuse to hold back. I think we should work on standardization. It makes it much more accessible, as Martina actually have mentioned before, if you have a standard. I think private market has done quite some work. I see, of course, very encouraging signal also from the public side. Again, having listened to the vice president, it's super encouraging to see what is about to come. And that's why we need to bring the two initiatives together. And I always think if you have something which is jointly shared and where basically you have some stamp on it, this is best practice, it helps to accelerate a certain standard. I don't debate which one is better or worse, but important is that you look at the various initiatives, and that you decide which is the most promising. And then it would be nice if there's also some public recognition. And then basically you can bring the various market participants together. We are at the beginning of the journey. Momentum is here. If I compare a bit to the infrastructure discussion, which was also a big effort, not only in respect of sustainable, but also it's win-win. We need better infrastructure as a society. It contributes economic growth. Public financing is not sufficient. That's why you need to bring private market. But there again, I think we haven't really found the standard to fully mobilize the institutional money, the private money. ESG is a similar item. So many different initiatives, so many good initiatives. Important is that we somehow start to say, okay, which one is the most promising one, and get some public recognition. And that's why the most inefficient way is that we develop each our own standards and go in very different direction, be it on a national, be it on a regional, or on a global level. That's why having a G20, FSB, these are great bodies to give more weight to certain initiatives, be it on the private sector or on joint sectors.
Axel, you wanted to come in on this point?
Well, just another example. I mean, every industry part in finance has its own industry workhorses. For us, it's a diversified, multi-asset, cross-asset class portfolio. You know, your typical 60-40 fixed income equity and you increasingly have alternatives in there, you have hedge fund exposures. That's the typical workhorse. We moved to the first 100% sustainable cross-asset portfolio, and for that you need to work with specific firms to develop, say, a sustainable equity strategy that you can bring into this 100% portfolio. You have to work, for example, with the World Bank that usually issues debt instrument into institutional space to open up for debt and World Bank debt to be issued to private agents. It's a totally different governance, and again, I'm going back to the distinction we always made about retail and wholesale. As long as your major clients is wholesale and you issue into wholesale space, that is a space where you can assume a certain degree of financial sophistication and a different set of regulatory environments as you issue that, as when you, for example, like we're trying to do, move this into retail space.
Yeah.
And when you touch retail, you need a lot more disclosure, you need a lot more public sort of disclosure around this. You also need third-party attestation. And I think the real big bang for the buck is if in addition to institutional space, we open sustainable investments to retail space, I think it will be an additional momentum that we will generate there. Because, give you two examples. 80% of the clients of the future that we have will be millennials.
Yes.
If you look at millennials, they always want to combine financial return with impact. If you look at the inheritance of 70 trillion of assets that will be passed on, female participation in that is 70%. So if we look at our client space and we ask, for example, our clients, the difference is that many of these family offices and millennials and women investors really want to look at combining financial returns with impact for society and sustainable development. So, again, one thing that is very clear, there is not just a financial return for it, there is also a big client need. And we increasingly, as asset managers and as wealth managers, are not just selling assets on our platform that are available. We are actually going out creating new asset classes so that our clients who have a need for investing in that will find new investment universes to invest in. And that will be, I think, the big innovation that we will see over the next few years. Innovation in product generation rather than distribution of existing products. That's where you need to be at the forefront in the financial industry.
Massamitro, you wanted to comment on this?
Yes, because the three speakers actually referred to so many points on which the OECD has been either working on or have more homework for us. And we actually have a center on green finance and investment that will be certainly be the focal point for conducting this work further. But more specifically, actually the EU report made two very specific proposals for the OECD, and one is to produce a convention on long-term sustainability risks, clarifying that investor duties should incorporate sustainability issues. And second, the OECD to support and measure adult financial literacy on sustainable finance issues as part of their international, we have a network for financial education. So we're trying to address those issues. And by the way, we're also starting work on a certain follow-up to the FSP task force's work on transparency and disclosure.
Yes.
With your blessing, I hope.
Well, I know that because I'm meeting with your team tomorrow in Paris.
Yes. So we look forward to that meeting. But one important thread here, I think, is, or maybe I have two questions. One is, we have always been in favor of developing standards for more harmonization, but there is always a certain cautionary remark made by some of our colleagues that too much hardwired, maybe even prescriptive standards might actually be a straitjacket to a market development and could actually hamper the markets from functioning properly. That is one issue. And the other is that whenever we discuss those issues, we tend to discuss each issue in isolation, but when you take this together at the whole of government level, what do we end up with? And I go to this question of emerging markets where they have very specific issues around fossil fuel subsidies, for example, and it's very easy to say you should eliminate, but then those are very much linked to the particular social context in which those subsidies are applied. And all in all, of course, we want to have a holistic approach to all those issues and be helpful.
So how do you retain then? You said it's maybe not a good idea to be prescriptive, to hardwire issues. So how do you retain the flexibility in a sense and drive it forward? Maybe Martina, you want to answer that perhaps as a
Sure, yeah, with pleasure. I think there's also a difference between principles and taxonomies.
Yes.
And actually, that's what we've seen in the sustainable investment space as well as in the green finance space. Obviously, ICMA green bond principles have encouraged debate in actually driving the market without hampering it and providing sufficient flexibility, and from there taxonomies were developed. The same actually if you correlate this with what happened in the sustainable investment space with PRI and the 6 principles, and ultimately how taxonomies over time were developed and linked to this. At one point, I think, though, there is a tipping point. You know, there's a decision to be made of which type of standards are you applying. And this has led increasingly to confusion on one hand, on the investor side, of which in frameworks taxonomies to choose and to opt for. Yeah. And on the other hand, the reporting fatigue and conundrum at the corporate end, you know, and this will lead ultimately at one stage potentially to a lack of disclosure, transparency. This is again hopefully to be mitigated by the fact that we are now looking at further legislation, at least in the European context, but there is a potential for this, or ultimately for less of a focus generally of the investor community on some of these key issues. But I wanted to make, in this context, another important observation that's around TCFD and the work of the FSB task force, Aline, that you've been part of. Given that you were looking at financially material risks, I think this is probably one of the major differences in comparison to other frameworks, because predominantly the historic frameworks, again, and benchmarks, we mentioned DGSI, we're looking at sustainability information, but on a very, very often on a purely qualitative basis. So now we are combining financial materiality with potentially ESG risks, and importantly, as Axel mentioned earlier, opportunities as well, and then ultimately from there towards impact. And I think that's probably where the debate is getting very interesting, and it's driven from industry for industry. And I think that's another interesting development side by side. It's no longer just a standard setting organization and body that's driving this per se, or it's no longer a legislative regulatory framework that's been set up. It's a global phenomenon, probably similar to some of the OECD developments, clearly the OECD developments, IFC developments and others. That's really hopefully also enhancing global adoption. So quite something unique that's happened here with this TCFD framework, and probably HLEC and others to follow.
Guido, did you have a brief point you wanted to make on this?
I think for me it's very important to mention hardwiring doesn't sound very attractive.
No.
I absolutely agree. I prefer the term best practice. Either you join or you don't join. If you don't join, you will be in a niche. And I always think if we get a framework to attract the big flows, be it from institutional or retail, you create something much more meaningful, much more powerful. And that's why you must make it accessible.
But can you legislate for best practice?
Absolutely, you can give certain kind of a rubber stamp. Okay, that's best practice, and you can even look at securitization. Also, it was a private label initiative. What is a good securitization deal? Yeah. And of course, if this is supported by regulation, that there's some recognition, and that's why the Bank of England Governor Mark Carney, he mentioned climate risk is a systemic risk. Fully agree, absolutely correct. It's a systemic risk for financial market long term. So far, and that's why I'm really encouraged by this morning's speech by the Vice President, I haven't seen any regulation which gives an institutional investor an incentive to have a sustainable, impactful type of investment strategy via different treatment or maybe more nuanced discussion. That's why I strongly believe it needs recognition from both ends, that it makes sense for society, for investors, but also for shareholders. But ultimately, you want to have the same reflection, also the way how you're treated as an investor, be it from regulation or from rating agencies. So far, no recognition. I considered we are early in the journey. That's why clearly needs time until the dust settles a bit. Standardization best practice helps just to use momentum.
Is it just the E and ESG that is a financial stability risk, or so does that mean we should only focus on the climate and the E? Because that was a big debate actually in the high-level expert group.
No, I don't think it's just the E. If you look at some of the recent funds we've had, we've started an oncology fund, where basically the impact is you're raising money in order for helping sort of health-related issues. Impact investing in many emerging markets is really about disease fighting, about creating sort of basic infrastructure around healthcare, and that will have a big societal impact. And you can measure the impact investing world, which, you know, a lot of it started off as philanthropy, but it's becoming more professionalized, and people are looking, because in philanthropy, it's all about measuring impact and being clear about impact. So once you mainstream that's what I meant before, once you move a niche financial product like philanthropy to mainstream, you can have a lot of impact. Give you another example. Best-in-class shareholder engagement in the future will absolutely include integrated reporting and sustainability reporting, because you will not be able to have a good conversation with your investors if you are somewhat unclear about sort of your carbon footprint, not just as a company yourself, but also as an asset manager in your investment strategy and in your client base. So I think the world is moving in that direction. And I think really at the moment, I'm very much with where Guido is, leading by example and, you know, being innovative around that will bring many others that don't spend the resources on being innovative to more of these products once you mainstream them. It's all about mainstreaming, I think, in the next 5 years. And there will be some companies that will lead that. I was very glad to read when Swiss Re focused on that. And again, you know, we're talking Swiss Finance Council here. In Switzerland, there is a very strong focus on that. You know, take, for example, 100% energy efficiency on a sort of environmental basis. It's easier to do in Switzerland, given the large predominance of hydro and other, and the geopolitical and the geographical location. But it is something that our investors really look for, and I think there is a point to be made by going ahead and developing that. And I think, you know, there are many countries in the world that will join that, because we can never deliver on the Millennium Development Goals if this is not a common task. And I think it's very good that, you know, again, on the Millennium Development Goals, you know, countries can actually, because we know pollution is global, and so fighting pollution is a global task. It's very important as you raise money that you don't just do these investments domestically, but actually that you fight sort of, you know, the carbon emissions at the point where they're most impactful and in a negative sense on the economy. And that's where raising global money and a targeted investment strategy to improve the environment is very important. And I think some countries will fall behind. It's very evident in political debates, but others will have to go ahead. And I think that's a big chance for Europe.
So, I mean, this has been a fascinating discussion, and we're running a little bit out of time, but I just wanted to put a final question to you, really. You know, we see now that the European Commission is going to draft and write its sustainable action plan. And of course, part of the high-level expert group's recommendations was to say that the EU should start to lead this debate, particularly since the US has pulled out of the whole debate around climate and the Paris Agreement. So it's up to the EU now to lead the agenda here and to take leadership in the G20, the G7, the OECD, IOSCO. So I guess my question to you, to each of you in turn really, and who would like to start, is that if you were writing an action plan, and you were writing an action plan not for Europe, but for the global community, to drive forward sustainable finance, what would be your priority action? Axel, do you want to start, or?
Well, again, you know, let me sort of piggyback onto my question from before. We talked a lot about Europe. We talked to some degree about the US. Again, where is Asia in this? I was struck last year in Davos that the president of the People's Republic of China was actually in Davos leading the global environmental debate, which tells you, and you know, everyone of us that travels to China frequently sees it on the day-to-day how impactful environmental changes can be on your day-to-day. We've had days where our employees in Beijing did not show up for work because it was recommended for the kids not to go to school, so they had to stay home to look after the kids. That is something where you do not any longer have a theoretical debate about climate and climate impact. This is a very real debate in countries like China, and I expect that China and countries like that are most impacted by it, along with many emerging markets, will be the ones that will move ahead, whether Europe or America choose to stay on the sidelines or not. And I think the least we can do in Europe is to join that global drive, because it's very, very evident in those countries that something needs to be done. And I think, being last in this race is not a good position at all.
Okay, Martina, what's your...
Yeah, so from my point of view, I have a little wish list
Oh, okay,
the
but a wish list even
yes, which might be, first of all, what we said a bit earlier, to look for integrated frameworks to actually enhance capital flows and not to hamper developments. I think this is a key prerequisite. And looking at building more hybrids/products in the area of sustainability that will predominantly focus on quantitative information, hence better metrics, and hence, looking at mandatory sustainability risk disclosure, materiality factors in line with what's been recommended by the TCFD, for instance, but across the spectrum, not just for environmental issues, beyond that. And ultimately to systemically account for the actual contribution of investments and capital market allocation decisions to achieve societal and environmental goals. And then last but not least, to align the multiple workforce, task force, coalitions work we've seen across the spectrum, from investors, other capital market participants, and ultimately NGOs and think tanks and academics. And I think there's much more collaborative alignment to be done.
I think that's a 5-year plan you've laid out.
It absolutely is.
Guido, what's your...
Probably the most important thing is that the current momentum is used, and that you bring private and public sector as closely aligned as possible. And we talked a lot about documentation, much more standardization, but also on the reporting side. I think on the product side, I think we see very forceful offering. It's not sufficient, and green bond is a good example. There's much more demand than supply. Why? Because there's no standardization, no clarity how you structure such a bond and what is needed. Very, very obvious example. That's why we need to work that, and hopefully, again, with public sector also include regulation, that this is also see the benefit of having investment strategy. It's about shaping the future investment strategy, that this gets some recognition. That's, in a nutshell, how I would like to describe the hopeful future.
Great. Masamichi, you are, in a sense, our OECD international person.
Yes, well,
Expert on the platform. And so what do you think your priority is? And does it matter that the US is less engaged on this agenda?
well, of course, we would want to engage with the US, and in many respects, the US is taking part in a lot of the OECD work. So we want to further engage them in this respect as well. But coming back to one point that Guido actually referred to, I mean, the European approach will probably be centered on more legislative proposals or something that will lead to eventually rules within the EU. But to take this to the global level, I think you need more flexibility, and maybe this best practices approach that you referred to will be very useful. And we have such a thing as the corporate governance principles at the OECD, G20 OECD principles. We have stewardship codes across jurisdictions. We have stock exchange rules that actually incentivize certain approaches. So I think we can be very creative and flexible to bring this to the global level, and this will actually make a lot of difference in the medium to longer term.
Mm-hmm. Great. So, I mean, what's clear is it's a very dynamic, evolving agenda and debate, and I think we're very lucky to have a lot of experts actually who are very engaged, very committed, and indeed very passionate about the need to drive sustainable finance.